Hello and welcome. You're watching Money, Money, Money. I'm Samira Abdi, and if you're wondering what happened to our weekly set, well, let me tell you, we're here in beautiful Bangalore, and with us we actually have two master investors. So we have Rakesh Rawal and Anand Rathi, who between them would be having at least half a century of combined experience in advising people. Or have I overshot it?
No, you're very much on the line.
Underestimated. Okay, so that's brilliant because that's a lot of advice that's going to be coming our way. And not just that, we also have with us two investors who between them would be having at least half a century of investing experience, right? You've been investing for at least that, if not longer.
I wish I'd had that much of experience. If I'll tell you.
Time-wise, yes.
All right, so I'm sure there are a lot of stories that you want to share with us. So let's get cracking because we have between all of us now over a century of things to talk about. So let's get started. Mr. Chandrasekhar, Mr. Khandwala, thanks very much for being a part of our show. You were telling us that in this, whatever, half a century or whatever, 25, 30 years that you've been investing, you've had a lot of memorable experiences, right? So take us through how your journey has been.
Well, first and foremost, I mean, to those who are listening, I would like to say that, frankly, I wish I'd started a lot earlier. I think I started too late in the game. Most of us think that either you don't have enough money or you don't really have the time, etc. But I really think you should start thinking of investing as early as possible. Second, in my view, I had the most extraordinary luck or lack of luck. Because whatever I touched, some people it turns to gold, some people it turns the other way. So whenever I put money in the stock market, it would tank. Whichever stock I touched would go south. If I bought a house, the markets would crash. I invested in the Indian stock market. It started dropping like crazy. I pulled money out. The next week, the Dow had the biggest increase in the history of the Dow. So I decided, rather than do it half-baked, you know, where you really don't know and you're just casually getting information from here and there, this is an area where you need some help and some expertise. And that's one of the lessons I learned.
Okay, so that's a brilliant lesson actually to have learned, because otherwise you'd just be into contra investing, right? So everything that you want to invest, tell others not to. So what about you, sir? How's your journey
I
been?
think what Shekhar has said, a lot of it is true and applicable to me as well. Because earlier when I was investing, you met somebody at a party and you listened to them talking about a particular company is doing well and the share is going to go do better. So you go ahead, next day call somebody and buy those shares.
Those tips actually.
Yeah, but then you don't follow it up because you don't meet that guy the next time when he tells you that now it's time to sell, but that information doesn't come to you. So it kind of went on that way for a while, and then things began to change. Because then the planning came in and the asset allocation came in and so on and so forth. But also, I think investing early is very, very critical.
Okay, so that's great. So one thing that both of you agree on is that investors should begin as early as possible. And that's in fact, something that every expert has been telling us, that invest early, gain from the magic of compounding. But in theory, does compounding really work that well? Because you don't hear of so many people saying, oh, I started 25, I'm a millionaire today. You know, is it really just like theory and not so much in practice?
Well, it's like there's a theory is there. If you practice it, then you'll get the results. The problem is that we go thus far and then withdraw. So therefore, if you look at the Sensex value, 1980 it was 100 and it is 27,000 or 28,000 today. That's about a 17% compounding, right? So if you had just bought the Sensex, you would have had a 17% return on investment, right? The problem is that you go through volatility, which is ups and downs, and then you think that, hey, when the market is coming down, everything is going to come to an end and you withdraw, and then don't enter it again. So the fact of the matter is that passive investing for long periods of time also has led to fantastic results.
But Lavai, my question to you is, at 25, if someone wants to begin investing, okay, that's a time when you've probably taken a student loan, so you have the responsibility to pay it back. You're probably looking to start your life, you have a home that you must buy, so you must take on fresh liability. Should you invest? Should you look at your liability? What should be a person's priority at that time?
I think as investment advisors, our sort of primary responsibility, which we keep telling our clients, is to protect risk first. And I think that's the number one lesson that people need to take on board, that you want to make sure that you don't lose whatever you've built through something which is, sort of sporadic or without any sort of care. So I think protecting risk is extremely important. After that, you need to start investing.
I'm sure that's good advice, but you have questions for our experts?
Yeah, one of the questions that I have is, one talks of risk, right? So take me, for example, right? It's again a self-perception to some extent. I mean, my perception of myself is that I'm an average risk guy. But at the same time, I've also run a business. I've been a sales guy. I've done all those things in life. I also know that nothing ventured, nothing gained. Right?
Sure.
I mean, there's a direct proportion between risk and reward. So the question I really have is, how do you really establish the real risk appetite of a person? Is it just trial and error?
Any kind of management is goal driven, right? Now you can't do managing of money without establishing a goal for yourself. So the starting point of this exercise is that you establish a goal. The goal for money would be returns, right? So you establish as to what return you would want to look at. The next thing that you have to do is that if you have to achieve those returns, what kind of strategy to follow? What is the risk that you need to incorporate in your portfolio? What asset allocation to use? There's no simple answer to risk. There's no simple answer to make an assessment as to, hey, if the market is down so much, your portfolio is down so much, you will be able to accept it. You have to have hurt. Anybody who loses money will be hurt. It's the extent of hurt and whether it propels you into panic action. That is what you have to safeguard against.
Add to that risk question that you raised, and there are two parts to it. There's one that you mentioned about being a business owner and taking the risk. And we meet many clients who are business owners who are actually very risk averse because they say they take all their risk in their business. That's number one. Number two, I think it's very important for you to separate out what is your business goals and your personal goals. The other part that you spoke of risk, I think there are scientific ways of doing this. So there is a risk tolerance test that you do, which actually will throw out and tell you that how will you react to risk, how will you react to falls in the market. And there are, good set of these risk profile tests available. And as investment advisors, now we need to run risk profile tests. And the third is the capacity to bear losses. So if you are in retirement and you say, okay, my risk capacity is X, but you realize that if the market fell by 20%, you'll be wiped out in X amount of time, then so three factors actually scientifically to take into account for it.
All right, so that sounds actually quite interesting and something to ponder over. So we'll take a very quick break, and when we come back, we're going to tell you how much diversification is actually too much diversification. Stay tuned to Money, Money, Money. Welcome back. You're watching Money, 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 coming to you from Bangalore, and with us we have two experts, Rakesh Rawal and Lavai Navlakhi, and we also have two investors with us, Mr. P.R. Chandrasekhar as well as Mr. Sanjay Kandwala. So I hope you all have had an interesting time so far. I know I have. But before the break, I actually asked a question about how much diversification is too much diversification. This is something I want to ask both of you, because a lot of people who call in sometimes on the show, they say that, they've invested in 20 mutual funds. They have like 30 insurance policies, and they say they're diversified. So all they have actually is one asset class. So how much diversification, therefore, Rakesh, is too much? Where should someone draw the line?
Well, if you really look at worldwide wealth of HNIs, that's about $44 trillion. That's about 19% in real estate, close to about 30-35% in equity, about 8-9% in alternative assets, and the rest is in debt. Right? This is how the cumulative numbers of HNIs the world over stack up. Right? Now, there's no. I think that diversification is a offshoot of what kind of return objectives you set for yourself. And return objective is a direct offshoot of your aspirations, of whatever you wish to do, and where you see your money. But certainly, I think diversification is very, very important, also from the return, also from a risk management perspective.
Fair enough, but Leva, is there a rule of thumb for everyone else, all of us who are not HNIs?
I don't think there's a rule of thumb for anyone, because I feel that every person needs to have a different sort of portfolio depending on what their needs are. So let me try and give you an example of what is not diversification. So in 2007, we had people who were retired, very happy with the real estate asset class and saying that, 90% of my post-retirement requirement is coming from property rentals, and they are into 4 or 5 different properties. And what happened is real estate took a crash. I know of a particular client who had 4 properties. 2 of their properties the tenant vacated. So suddenly, instead of 90% of the need, it dropped to about 50-55%. And it took close to a year with a fall in rental for the person to get back the property on rent. So I think people tend to think that just because I have many of one particular class, I think asset class diversification is probably more important than within the asset class.
So you want to talk about how often do you review your portfolio?
Well, we review it every month. But it's not that each time you review your asset allocation and things like that. You just go over the numbers, and if there is any major change that is needed. But the question, maybe going back to the previous segment, is that when you see a market either improving or going down, you have a tendency to change your asset allocation between, say, debt and equity or what have you, to suit that trend. Now, the real thing probably is to resist it, but it's very difficult. So, what's your take on that?
Very simple again. I'm harping on the same thing, and I will continue to harp on the same way of managing money. It has to be objective oriented. So if you've got a 12% objective, and if that can be achieved with a certain asset allocation, then so be it, right? And if the markets are helping you, excellent. If they're not, be patient. They will ultimately help you. So the point is that, your asset allocation is an offshoot of your return objective. So if you're happy with that return objective, then get there with the least amount of risk. That's the principle that we follow. Now, if, for example, you believe that, hey, I need to change my return objective for whatever reason, so let's change it in a conscious manner, and then change the asset allocation in the same fashion. Now, I think that we have to move away from the drift mechanism of management to a well thought through mechanism of management. Another thing that is very, very important is in asset classes is, especially equity, is what kind of valuations the markets are sort of trading at. The fact of the matter is that if you are very much off the average on the high side, certainly your risk levels are far greater as compared to if you are much below the average valuation. At which point in time you need to be very careful in terms of what kind of allocations you've given to equity, and there are hedging mechanisms that you can also incorporate to make sure that if in case of some events leading to downside of markets, your fall is not as hard as would have otherwise been.
So we're going to take another quick break, and when we come back, we're going to tell you a little bit more about how to keep emotions out of investment. Welcome back. Here with Money, Money, Money that comes to you from Bangalore. Our two experts, Lavai Navlakhi and Rakesh Rawal, have been doling out advice, and we have Mr. Chandrasekhar and Mr. Kandwala, who've been actually very eager investors and eager to know a lot more, I'm sure. But one question that's been troubling me, and Lavai, how often have we actually dealt with this? People invest when you tell them to invest, and when you tell them to sell or get out of it, they don't. How does one actually keep emotions out of investments?
Yeah, I think that's probably the toughest part. I mean, we keep telling people that you need an advisor if you do not understand finance, you don't have the time, and some people have the time and understand finance. But I think third, very important, is how do you keep emotions out. And the way I see it is that if you're a doctor and you're dealing with gangrene in your left thumb, you want to cut it off, otherwise it will spread, and that's very difficult to do if you've made the investment yourself. I think the biggest problem possibly is that investors don't spend enough time selecting their advisor. So which means that, maybe talk to other sort of investors, get references, talk to the advisor, meet them 2 or 3 times before they decide to start. But I think once they've decided, it pretty much should be a sort of a high trust sort of game, because otherwise, there are 2 human beings at the end of that conversation, and if you really push me hard and say, no, I think that Greece will have so and so impact, so you should do XYZ action, and I don't believe in it, finally for that investor, I shouldn't get bulldozed into taking that action and making it much worse for the investor. So I think that's probably the toughest thing to do, managing emotions.
Yeah, and I don't think Greece has been discussed on any other show as much as it has on Money, Money, Money. But Mr. Rawal, is that a problem that you also face? I mean, how much hand-holding do you think a client really needs? And at what point do you think a client might get disappointed and say that, I was fine, I was doing well on my own, why do I need a financial planner if he's not going to be holding my hand every other day?
Well, I think that at the end of the day, it's a combined effort of the investor and the advisor that leads to whatever results it leads to, whether they are good or whether they're bad. And I think the responsibility lies with both of them together, right? And the advisor, in my opinion, cannot just be an information supplier. He has to have the ability to create conviction on the other side. See, it's the action that will lead to results. Otherwise, you'll make that statement, I told you so. That's never helped anybody. If my father had bought that house in Basant Vihar, I would be a multimillionaire. It really doesn't help. No, he did. He had 50,000 rupees, and that is what is costing them. The point I'm making is that we as advisors need to take responsibility of putting passion behind our advice and making sure that the action is taken by the individual. Now, and that's something that I call no fear advisory. Many a times I hear that, hey, let's not give this advice to that gentleman, he won't take it. That's not relevant. What is relevant is what's your belief? What do you think is right for the individual? You bring that on hard. Then it's up to the person to take a call, whether he wishes to take that call, doesn't wish to take the call. Your job is to bring it hard. And then if you do that, chances are that more and more decisions that you take will be on the basis of sound logic and less by emotion.
That's really the hallmark of a good planner, which is they tell you not what you want to hear, but what you should hear.
Absolutely.
And the final,
I add one small point to this, which is that at the end of the day, I think most of the people, let's assume, are reasonably rational, logical, intelligent people. So, with a certain risk profile. So what, at least say, in my case, I would look for, even in normal working life, right? So when a guy comes to me and says, give me more money, I need to add 4 more people, or I want to invest in this plan, I have a tendency to first push back. Why? I'm just testing to see how it is the conviction of this person. Is he convinced to come back 3 times and ask me? If he himself is not convinced, I will not give him anything. Right? I have an instinctively follow that even with my advisor. I sometimes push back and test, and I found the good ones will tell you the same thing regardless of whether you're pushing, not pushing. And I already have a certain sense. And if that overlays on that conviction, because I'm testing actually the conviction of that person,
Yeah.
which is based on logic. It can't just be conviction that, okay, markets are going up. I won't buy that, because I'm intelligent enough to figure that
Sure.
out. But there is a conviction which says, okay, I think we are in good hands or good shape because of X, Y, Z. And I say, you know what? There's logic, there's conviction. I'm okay. I can now live with this.
No, but there is another problem that is faced by investors, I think, that several product marketeers pose themselves
Yes.
as advisors. And a lot of people get into that and they buy a product without really knowing the overall situation. I mean, they don't care. They just want to sell. And everything looks very rosy. But then whether it really fits into your goals, into your thing, that is left for you to judge and decide. And I think that is a major pitfall.
All right, so it's been lovely. We've actually discussed a whole host of issues, and I hope that all the people who are watching at home are actually going to benefit in some small way from everything that we've discussed so far. Thank you so much for being a part of our show and for actually taking the time out to be here. And thank you so much, experts, for actually advising not just our two investors here, but also the host of people who are going to be watching this. Thanks very much for your time and effort as well. All right, with that, we'll wrap up on money, but do stay tuned. There's lots coming up on CNBC TV18, and as always, we'll see you again next week. Stay tuned.